the different types of mortgages available out there in today's market and which one is right for you. Hi, this is Omar Scanu with RE/MAX 5-Star Realty, and a home is probably one of the biggest purchases you will ever make. And so today we want to discuss the types of mortgages that are available and that are right for you if you cannot pay for cash, which at the end of the day is still the smartest decision. Choosing a loan isn't as simple as it sounds because there are many loans types available out there, and they're made up of different components such as length of the loan, interest rate. So let's take a look at the pros and cons of each so you can make an informed decision when it comes to your mortgage. When you choose a mortgage, one of the first things you do is determine how the interest rate is handled. You can lock the rate, make it adjustable, or a combination of both. For example, if you get a 30-year loan with a 5-to-1 adjustable rate mortgage, that means your rate will lock for 5 years and then adjust annually for the remaining 25 years. The pros of a fixed rate mortgage here are pretty obvious. You know exactly what your interest rate will be for the life of the loan, which will allow you to plan and budget accordingly. The con here is compared to an adjustable rate mortgage, the interest rate may be higher at first. Sure, the initial low interest sounds appealing at first, but down the line, higher rates could get transferred from the lender to you, increasing your payment overall. And that payment could quickly become too much for you to afford. Bottom line, ARMs, adjustable rate mortgage, are one of the worst possible types of mortgages to get. Keep more of your money and go with a fixed rate instead. When we talk about mortgage terms, we're referring to the length of time it takes you to pay back the loan. Common terms range from 15 to 30 and even 50 years. A 15-year term keeps you on track to pay the home fast with lower interest and total costs compared to a longer loan. A 30-year mortgage means 15 years of debt and thousands of dollars additional paid in interest. If you can, go for the 15-year term, pay less interest, and add extra payments to pay it off even faster. Another type of common mortgage loan that we use every day is a conventional loan mortgage. A conventional loan is a deal between you and the lender that meet Fannie Mae's underwriting guidelines. When you calculate interest and fees, your total cost for a conventional loan is lower. But conventional loans aren't backed by the government, so lenders can charge a higher down payment and interest. Also, this type of loan requires you to pay PMI, private mortgage insurance, if your down payment is less than 20% of the home's value. PMI protects the lenders if you default on your home, but does not go towards paying off the loan. With the Federal Housing Administration, you can get a mortgage with as little as 3.5% down payment. The only downside to this one is that you'll have to pay MIP, mortgage insurance premium, which is a fee similar to private mortgage insurance or PMI, except you have to pay it for the life of the loan. The only way to remove MIP is if you have a down payment greater than 10%. MIP can tack on an additional $100 per $100,000 borrowed. So if you have a $200,000 home, that's an additional $200 in MIP. No thanks. The only caveat here is that when you purchase a home with zero down and things change in the market, you could end up owing more than the value of your home. VA loans also come with a funding fee. This fee can range anywhere from 1.5%, 1.25% to 3.3% of your loan, depending on your military status, down payment amount, and whether it's your first time purchasing a home with VA benefits. That's anywhere from $2,500 to $6,600 on a $200,000 home. Finally, the United States Department of Agriculture also offers a loan program managed by the Rural Housing Service to people who live in rural areas and show a financial need based on modest or low income. With this loan, you can purchase a home with no down payment and below market interest rates. The only caveat here is that you cannot refinance your loan to improve your interest rate, and the prepayment penalties are horrendous. So in conclusion, my bottom line here is avoid higher fees and hidden restrictions of unconventional loans. Go with a conventional loan and pay a lower cost. Again, this is Omar Scanu with RE/MAX 5-Star Realty. Thanks for watching the Houston area Realtor vlog. Please comment below your thoughts. If you have any questions, let me know. I'd love to help you. And be sure and subscribe to the channel. Thanks for watching. And visit omarscanu.com.